Scott Black, Delphi Management, a couple more gray hairs over the last couple weeks. Scott, what have you done during this market downturn? How do you react given the turmoil, the volatility we've seen recently?
Well, we try to be opportunistic. We look for companies that have been blown out where the earnings are very good, that still have high returns on equity, but, really sub-market PEs. And there are many more opportunities today than there were, let's say, 4 or 5 weeks ago. I mean, selectively, we sell stocks that we think might not do well if the economy's sluggish, but we replace them with better companies overall.
Okay, here's the ratio, folks. Russell 1000 growth to value. You can see that growth boomlet at the late part of the 90s, and then value takes over, possibly because growth did so lousy, and growth's coming back a bit. How growthy is your value investing now, Scott Black?
Well, Warren Buffett said it's a misnomer to consider people in a pocket like value or growth. The idea is to buy growth businesses at value prices, and that's what we try to do. But the bottom line is, you're quite right. If you look at things like the Russell 2500 value and the 2000 value, they've lagged significantly against the Dow and the S&P year to date. And even in this month, they're off much more substantially than the bigger cap indices.
Will earnings hold up?
I think they will. We're at about a $98 run rate. The latest quarter, with 99% of the precincts counted at S&P, so to speak, was up 18%. It's hard to know, to prognosticate into next year, but on an absolute basis of this year's earnings, you're at 12.2 multiple, which by historical standards is very cheap. The problem is all the other macroeconomic noise, both in Europe and the United States, that overhang the stock market.
Okay, here's Jonathan Golub, a smart note today from UBS. We'll get Mr. Golub on here, radio and TV at some point. It's the note of the day: cyclical stocks to offer superior value. The market has rotated towards defensive stocks, reflecting growth and macro concerns. That's like economic concerns. Next 12-month earnings estimates have risen by a greater amount for more economically sensitive names. Within the PE dynamic, Scott Black, are earnings going to stay with us here? Are we going to have the denominator stay strong?
Well, I think earnings will hold up, and one of the things you have to look at, because we own companies, and you mentioned earlier Cliffs Natural, but we bought things like Parker Hannifin and Illinois Tool Works and Eaton on this dip. They have a big exposure overseas, and not all of it's Europe. A lot of it's Asia, so that will buffet them against the wind. And of course, companies that do have business in Europe, the Europe has rallied against the dollar, and many of them are unhedged. So in many cases, you get the back to your wind, the wind to your back, so to speak,
right,
from the rise of the euro, and also you got Asian exposure. So I think that earnings will hold up, but it's not a given that the economy doesn't slow in the United States, and that there's a lot of operating leverage in these manufacturing companies, and if the order books shut down, earnings come down. The one area that is vulnerable, the semiconductor capital equipment stocks, they're all very well run, they're cheap statistically with great balance sheets, but as the book-to-bill ratios drop below 1, and there's not a lot of visibility, and overall cap spending probably will dip from $32 billion back to $28 to $29 billion. These types of cyclicals are vulnerable, and you can see that the earnings estimates are already down year over year for the prognostication for 2012 versus 11.
Here's a very different chart. I'm so glad, Scott, you brought this up. Abbott Labs, ABT. This is the stodgy Scott Black. Looking at beautiful things in the museum up there in Boston. This chart really is remarkable, folks, how Abbott Labs has not come down over the years like so many stocks. Why is that, Scott? Is that because it's a takeout candidate?
No, it's because they don't have patent cliffs. They don't have a Zyprexa or a Lipitor. Humira is their biggest drug. It's over $7 billion in revenue, and it doesn't come off patent until 2016. And they're also well diversified. They have nutritionals and vascular, and so it's a good book of business. We think that the secular growth rate on top line is maybe 5 or 6%. The bottom line 8 to 10 with margin improvement and stock buybacks. The stock is still selling only at about a 10 multiple. It's 51 as we speak. We think they'll earn $5, plus you get a 3.8% yield, so you're paid to wait, and they generate nothing but cash. It's a well-run company.
Who would buy them?
I don't know that it's a takeout. I don't buy companies on the basis it's a takeover play. I just think it's a good business on its own.
Okay, look at this video, folks. We had to go to the surveillance Midday team to find out if Guess was cool, and it was a massive, Scott Black, massive, hands down, aggressive and vicious, hands down, by the Crack Surveillance Midday fashion team over Guess is a lame brand. Do you like this because it's so blown out and so out of favor that there's nowhere to go but fashion up?
I agree with what you just said. You know, the stock's been blown out from 51 to 34. They lowered the guidance by 12 cents. Instead of earning 342, the low end is now 330. We still think they'll do 370 to 375, which puts it at 9 PE. This is a company that earns close to 30% on book year in, year out with absolutely no debt, just under $5 a share sitting on the balance sheet in cash. And this one does benefit from overseas. Over 50% of the revenue of the company is Europe and Asia. It's no longer a North American play. And of course, it's 100% fashion oriented towards women, jeans plus accessories. But the bad news is out. It's down 20 points.
Is the management engaged to benefit shareholders? That can be a problem sometimes in fashion, can it?
No, this company's had a straight-up earnings record, and I think they look to the shareholders. It's not like the management's overpaid. We've owned this company off and on for years, but we think this is a terrific entry point here. As I said, the stock is really washed out, and it's selling at a roughly 9 times next year's expected earnings.
Earlier this morning on Bloomberg Surveillance, I spoke with Mr. Ross of W.L. Ross & Company, and I asked him what's the biggest mistake people make in cash flow analysis.
The numbers are the result of things, not the cause of things. So you really have to look at why is there a cash flow shortage or why is there an abundance of it. So I think the cash flow statement is very, very useful, but it's not the answer. It's what leads you to other questions.
I love that idea. What does it lead to other questions? That's how the pros do it. Scott Black with us from Delphi Management. Scott, cash flow is oh so in. What do people get wrong right now when they use cash flow analysis?
We look at free cash flow. There's a difference. That's a mistake, just adding net income plus depreciation, deferred taxes, and subtracting out property, plant, and equipment. We look at the net working capital. So a lot of people are simplistic. You really have to look at all of the accounts and to see if the company generates cash. Then if it's capital intensive, you have to look to see if it's inventory and receivables intensive like an Arrow Electronics, or whether it might be capital goods intensive like an Ensco, which is an offshore driller, which would cost $500 million for an incremental rig. But if a company's a consistently negative free cash, that should sound an alarm bell that something's wrong with the business.
I like how you put that, and you also mentioned mid-cap stocks. One of the big traps I face, and a lot of others, is we're big cap, big cap, big cap. Is there more value right now in the mid-cap 400?
I think that's a true statement. We're finding more opportunities in smaller companies. Look, you can buy big companies that don't have a lot of growth. You can go out and buy Dell or Cisco or Hewlett Packard along the way, but maybe their top lines are only 3 or 4% at the margin, and that's not good enough. You like smaller companies that still have opportunities to grow, let's say high single, low double-digit kind of growth, because otherwise, if it's a high-speed grower, it's not going to fit my kind of multiple discipline.
Scott, let's get in Cliff's Natural Resources here. I assume iron ore. Do I assume out of Minnesota and the Edmund Fitzgerald and Lake Superior?
Yeah, you're right. That's a part of it. And then they bought Thompson Mining in Canada, and they kept the contracts with the Chinese. So right now, this year, they'll produce about 43 million tons of ore. They're ramping up to about 52 million worldwide. They also have a met coal play in the United States. They do about 4.5 million tons, of which only 1.2 million is steam coal. The rest is met coal, which is used for coking, and they're expanding that as well. I mean, the stock is ludicrous. It's 81. It's down from 102. They'll do about $13.50 this year. The forecast earnings are north of $15 next year, which puts it at roughly a 5 PE. I mean, it's ridiculous. You're buying a company that earns over 30% on equity at 5 times earnings, and they generate free cash, which we alluded to when you asked the question earlier.
Scott, to Marathon and the spinoff, in Marathon trading, as some analysts have told us, at 3 times EBITDA, do these managements have a responsibility to consider going private?
No, I think it's okay to be a public company. We looked at the Marathon spinoff, and we're very conservative. We normally assign like $12 a barrel for proven reserve of oil, and then maybe $2 to $2.25 per MCF for the natural gas, and to take out the debt and deferred taxes. And even though the Marathon looks cheap on price to EBITDA, it didn't look cheap on price to breakup value, which is another criterion. We like companies that sell below their asset value.
Great. Scott Black, thank you so much. Delphi Management.